Good day, students. Once again, I will be doing another question on the weighted average cost of capital topic. And I have done a video previously on the same topic, and it was on question 2 of the 2018 question bank first semester. And I'm doing this question, and this question is very related to question 19 of the first semester of the question bank. So after completing this question 6, which is hotels 365 out of 30 marks, you can be able to easily attempt question 19 of the question bank, and where necessary I will perhaps check the name of that exercise so that you can easily go and you attempt that exercise. So now it is Simon and Son. So after completing this question or watching this video, please do revise Simon and Son question 19. That question will really show or it will be a question where you will be applying your understanding of the concept of WACC in regard to this level of assessment in this question. So please do go through question 19, Simon and Son. WACC question is very similar to this one. Now it says Hotels 365 Ltd is a hotel group that operates in the Western Cape. The following is an extract of the statement of financial position at 30th of June in the year 2004. So this is the extract of the statement of financial position. And we have the equity and liabilities, and our total equity made of shareholders' equity, 20 million million issued of equity, and we have retained earnings. We have preference shares. Very importantly, preference shares are likely to be used in this question. Then we also have debentures of 850 million, and those are the two major financial instruments that will be used. At the same time, ordinary are not visibly here, but we'll look at them perhaps later on. Maybe it's under shareholders' equity, that 20 years, that will be the ordinary. The shareholders' equity or ordinary shares will be that 20 million. So now we have the three major financial instruments that are likely to be used in this question. Then we have deferred tax. Normally, current liabilities are not treated as part and parcel of the financial instruments because they are just short-term funding instruments that are paid within a period of a year. Then after we have just briefly analyzed that, then we can go to the information that is provided to us. I don't prefer to go to the requirements, but I prefer just to go through, and I'll explain some other stuff that are very, very important. Now, on top, before I go to the additional information, on top it is clearly stated that this is weighted average cost of capital. As I said to you previously, there is no necessity, or it is high likely that in your or during your exams or assessment, they will not tell you that you must use WACC to analyze the financial information presented to you. They might just present you with the information, and the minute you see that you are dealing with preferences, debentures, ordinary capital, or ordinary shares or capital, then you already know that you are dealing with the weighted average cost of capital. It will always be clear from the information that is provided to you. And sometimes this information might not be extracted in the table format like the statement of financial position. It might be given to you in sentences or in paragraphs. So still be able to extract such information and apply where necessary. Then now they give us ordinary share capital or ordinary stated capital, and it says the number of issued shares has remained unchanged since the incorporation of the company. The first dividends were declared on the 1st of July 2004, and amounted to 12 rand 50 cents. These are the dividends that were declared on the 1st of July. Remember, the accounting period for the business is ending on the 30th of June. So now, meaning 1 day after June is the beginning of the new accounting period. So now this was the beginning or the end of the previous accounting period, where the dividends amounting to 12 rand 50 cents in the year 2004 were declared. And remember, we are no longer in the year 2004, but we are in the year 2014. So there is a 10-year difference between these periods. So this will be 2, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So now we have a total of 10 years. There is 10 years difference, and this is very important. So now these dividends were declared 10 years back, and we are 10 years down the line. But I'll explain a little bit of this later when I'm completing the question and doing the WACC table. I don't want to do it now because it might not make sense perhaps to some students yet. Then it says, since the first year of declaration, the dividends increased at a constant growth rate. So now this is what we call a constant growth rate. The question clearly states that it is a constant growth rate. So now there is a formula for the constant growth or the constant growth rate method, where we can use that to calculate some cost of equity. But let me hold there. There is teller that there's been increasing at the same rate, and management expect that the growth rate will continue in the future. So now we need to know the rate at which these dividends have been growing, which was the constant growth rate. But as I said to you, that I'll explain this bit later on. And it says dividends were declared on ordinary shares at 25 rand per year, and this is per share, and this is in the current year now, 2014, which is the current year that we are busy with. So this dividends that were declared at 12 rand. Remember, 10 years down the line. Now I think I have to do this because information is just triggering me to do it. 10 years down the line, we declared dividends at 12 rand 50 cents. That was present value. In the future, 10 years after that, we declared dividends at 25 rand. So now, remember, we are told that the dividends have been increasing at the same rate or at the constant rate. So we might be concerned, at what rate were these dividends increasing? So now we can easily do that calculation where we calculate the growth rate, of these ordinary dividends. We know that present value, meaning 10 years down the line, these dividends were declared at 12 rand 50 cents. And in the future, which is the current period now, plus or minus, we see that there were dividends currently declared at the amount of 25 rand 10 years down the line, which is in the future from 2004 to 2014. So now, meaning our N now will have to be a total of 10 years. So now our N will be 10 years. And from here, we can compute the rate or calculate the rate at which these dividends were constantly growing at. Remember, I am using the Sharp calculator. I don't want not to remind you of that. I am using the Sharp calculator. So now my calculations will be based on the Sharp calculator. Then now we are computing the rate, compute I, in other words. We are calculating the interest rate or the rate at which our ordinary dividends were growing in the past 10 years and in the future expected years. So we have 12.5, and 12.5 is our PV, and plus minus 25, which is the future value. 10 is our N, and we are looking for the interest, and our interest will be 7.177346254%. I'm just writing it all so that you can see everything before I write only 7%, which is the rounded off or rate, which is 7%, meaning these ordinary dividends have been constantly growing at 7% for the past 10 years. So we do have our growth rate. In other words, this is the growth rate, the rate at which these ordinary dividends have been growing in the past 10 years and also in the expected future years. As they say that management expect this to continue in the future. So we do have our growth rate. Now we continue from that and said that the payment of the dividends are however still outstanding, but that will not impact our calculations. Either they were paid or they were not paid, the calculation of the growth rate will still remain the same. Then after it says ordinary shares are currently trade at a market value of 225 cumulative. Take note, meaning these are now the very important part, which link with the previous question or previous information. We had dividends that were declared and said the payment of these dividends are however still outstanding, meaning whatever was owing in the year 2014 must have been added to that 200, meaning the dividends were 200, but because they are cumulative, so we added 25 rand, so now it became 225 according to the market. However, the current price of the dividends is 200 rand before we added the one that were not paid. Remember, cumulative dividends, it means that if dividends are not paid in any given period, they are added to the dividends of the next period. So meaning dividends according to the market is 200, but after we have added 25 rand, therefore now they became 225 rand. Why? Because 25 rand of dividends declared at the end of the current year were not yet paid or were still outstanding. So now be mindful of that 225, where 200 is the current dividends that according to the market values, but 25 is from the fact that 25 rand was not paid, so we have to add that to the market. Then I want to just bring to your attention something very small, then after I leave it hanging and I will complete that at the end. If you look at this information that we are provided, we don't have the cost of ordinary shares. Remember, in the previous question, they said cost of ordinary dividends was, or equity was 20%. And in this case, we don't have the cost of equity. So now, if we don't have the cost of equity, there is a formula of calculating cost of equity, which says cost of equity is equal to dividends at the end, divide that by the price of the dividends plus the growth rate. That is why it was important for us also to calculate the growth rate. And now with regard to question 19 that I referred you to, question 19 of the 2018 semester 1 question bank, the Simon and Son that I spoke about, this rate is already calculated for you, so you don't have to be calculating this rate in that question. But in this case, we had to first calculate the growth rate. Then after, now we can come to the to the formula and say dividends, D1 is dividends at the end, meaning after the dividends has been added with the growth rate, meaning after the growth rate has been added. So now meaning when we are calculating now our dividends, we'll have to say our dividends declared was 25 rand. And we know that these dividends increase at 7%, 0.07. So we add 7%. Then after, we divide that by the price of the dividends. Remember, price of the dividends is 200. But after we added 25 rand, which is the cumulative one, then it became 225. Otherwise, the price of the dividends, according to the market, it is 200 rands. Then we multiply this by, we add the growth rate of 7%. I'm just doing my workings, 0.07. So now meaning the cost of equity, meaning the cost of ordinary shares will be, the cost of ordinary shares will be a sum of 25 times this by 1.07, which will be 26. Then we divide this by 200. Then after we plus 0.07, Then after we multiply this by 100 to make it a percentage, meaning the cost of ordinary dividends or the cost of equity or the cost of ordinary shares is 20%, meaning 20.375. Just to write everything, 0.375%, which is equivalent to 20%. So now, in this case, we have to calculate the cost of equity using the formula and also taking into account the cost of or the growth rate which was given to us. Very important to take note of this question because there was quite a number of things that we have to take into account before we do our calculations. So please be mindful that the cost of equity being ordinary, in this case ordinary capital, it is 20%. And in this case, very important, as I said to you, that question 19, the growth rate is given to you, meaning this 7% that we have calculated is given to you. Just to change the color, this 7% is given to you already, the growth rate. You just have to make sure that you take your 225, which is a different amount. In that case, you minus these dividends declared in the current year, because also in that exercise, they are cumulative and they are after the current one that were not paid have been added. Then you'll get to whatever the rate was. And in this case, we have the cost of equity as 20%. Cost of equity will be useful in the future. So now I have completed everything that I thought I will do in the future regarding the ordinary shares or ordinary capital. So now let me then proceed on that same note and I go to the second, or before I go to the second, let me complete everything that has to do with the ordinary capital. So now let me do ordinary capital or ordinary shares, if you want to call it like that. So ordinary capital or ordinary shares, it will be ordinary shares that I am dealing with. Then my ordinary shares, and my ordinary shares, I know that we have a total of ordinary shares and that are supposed to be given to us somewhere in a trial balance. Yes, we do have shareholders equity, which is 20 million shares in issue, 2,500,000. Oh, sorry, that was the capital. We are looking at the 20 million number of shares. In this case, we're not much bothered about the capital. So now we have to say price according to the market, term this by the number of shares. Price, term this by the number of shares. So we have to look at the price. How much is the price of the ordinary shares ordinary dividends according to the ordinary shares according to the market. Now our ordinary share price according to the market is 225 and is cumulative. Our shares are currently trading at 225. So this is our ordinary share price according to the market. Remember, this is after they added 25 rand. So we need to minus 25 rand so that the current price is 200, excluding the dividends that were due in the previous period, or in the current period of 25 rand. So the current trading price according to the market is 200, which is we are looking for the ordinary capital according to the market. So we can say 225 minus 25, and we multiply this by 20 million shares. 20 million shares. Let me confirm that it is 20 million shares or not. The number of shares that we have, it is, yes, 20 million. There is 20 million of the ordinary shares or equity. So now we go with that same note, then we determine how much will be the capital of ordinary. Capital of ordinary, it will be 200 times by 20 million. 1, 2, 3, 4, 5, 6. This gives us 4, 2, 3. So we have that 4 billion is 4 trillion. I hope I'm calling that number very accurate. Then after we have, yes, 4 billion or 4 trillion. Then we have completed our ordinary share capital according to the market. Then after we go to the second source, remember, it's likely that the question wants us to calculate according to the market. If they give the market, it's high likely. Let us confirm if does the question instruct us to do so. We are required to calculate the weighted average cost of capital based on the current capital structure, meaning we must not change according to the new capital structure, by making use of the market values. Take note, we must make use of the market values. So now hence we took the price of the ordinary shares of the market, which is 225 minus 25, and that was 200. So now that is why we took the 200 and we multiplied. So now we continue to number 2. And number 2 says preference shares. The non-redeemable preference shares have no conversion rights and carry a dividends payout of 12%. So we pay 12% to our preference shareholders out of the capital that they have invested. And we know that our preference shareholders invested a total of 1,250,000 rands in the form of preference shares. So now out of that amount, we have to give them 12%. So if we give them 12%, meaning 12% becomes dividends that are due to our preference shareholders out of that 1,250,000 rands. So now meaning we have to say times this by 1,250,000 rands to determine how much are we supposed to pay to our preference shareholders every end of the year. 1,250,000 rands, and we divide this by, or we multiply this by 0.12, meaning we have to pay 150,000 rands to our preference shareholders. So 150,000 will be our preference dividends according to the rate that we agreed with the preference shareholders. And the agreed rate, which is can be called a coupon rate, is 12%. However, similar preference shares have a current market return of 10% per annum, not the 12% that we give. So the question is, how much then would have been the capital if we have to take it according to the rate of the market, not the rate of 12%. So now we say we already have dividends that are paid at the amount of 150,000. Then we want to know the capital now according to the market rate. So we divide this by 10% in order for us to get the capital of the preference shares according to the market rate, not according to the 12.5% that we give to our preference shareholders. So we divide this by 10, then after it gives us 1,500,000 rands. 1,500,000 rands. So that means it is 1.5 million of the capital, preference capital according to the market. Then let us go and we record that, which is our preference share holder or preference share capital. So now our number 2 is our preference shares. So now we deal with the preference shares. And I want to emphasize this to you, that if they would have told us that preference shares mature in 5 years. Therefore, now we have to use the formula method where you must apply the calculator. I'll show you that with the dividends. So now we first have to calculate the preference dividends. Our preference dividends according to us. Our preference dividends, we said that it will be 1,250,000 rands, times this by 12%, and we said our preference dividends will be 150,000 rands. Then after we calculate our preference capital according to the market values. This is the market preference share capital according to the market values. 150,000, which is our current preference dividends. We divide them by the market rate 0.10 to determine the capital according to the market rate. Then we will have to say is 1,500,000 rands. Already calculated that. 1,500,000 rands. So according to the market, this will be the capital that will be needed according to the market. So now we have taken the second financial instrument into account, and we go to the third financial instrument. Then the third financial instrument is likely that we have to use a calculator. Then we go to the debentures, and I want to do a little bit of comparison of what could be done regarding the preference shares that can be similar to debentures. They say debentures mature in 8 years. Remember, this can be copied and pasted under preference. They can say preference shares mature in 8 years. So now that will mean that those preference shares are redeemable. In this case, they were non-redeemable. And if they are non-redeemable, meaning we will not have the maturity date, meaning the date at which they are bought back or redeemed to the preference shareholder. But in the case where the preference shares are redeemable, therefore now there can be maturity date, and where there is a maturity date, you'll have to apply the same principle that I will be applying in the debentures now, unless stated otherwise. So now we have our debentures that mature in 8 years at a discount of 2%. Previously, it was at a premium of 10%. A premium is added to the capital, but a discount is deducted from the capital. So meaning in this case, under our debenture capital, meaning the amount of the debenture, which is that 850,000, we have to deduct 2%, meaning only 98% will be a future value payment or redemption to the preference to the debenture holders. So now meaning the amount that will be paid in the future will be a sum of 850,000, and that will be 850,000 rands times this by 98%, and this will be 810 or 83,300 or 833,000 rands. So we have 833,000 rands, which is the amount that will be paid in 8 years to come to our debenture holders. So this will be what will be paid in 8 years to come in the future. And remember, our N will be 8. Our future value will be the amount after we have deducted the discount. So now let us go to our debentures, and we just do as usual. The minute there is maturity date, you must know that you must use the calculator. So our N is 8. Our future value is plus or minus. I want to show the calculations here. We have debentures of 850,000 rands, and the debentures of 850,000 will not all be paid or will not all be redeemed. So now only 98% will be paid to the preference or to the debenture holder. So meaning we will only pay 98% of the full amount. In the case where it is a premium, you add a premium. I want to emphasize that's 833,000 rands. If it's a premium, you add. If it's a discount, you deduct. Then after, we have to say how much are we paying to the debenture holders every end of the year. How much are we paying to the debenture holder every end of the year? Remember, debentures attract tax because we are paying debenture holders in the form of an interest on the amount they invested in the company as a debenture or in the form of debentures. It says the debentures carry an interest rate. Do you see? An interest. And interest will affect your income statement. So now anything that affects your income statement as an expense, you don't pay tax on that, but you are reducing your profit. So you end up now paying less of tax to SARS because of the allowance of the interest that is a deduction on your income statement. And they clearly stipulated that it is before tax. And I said if they are quiet, the assumption will normally be that there is before, the amount is before, or the rate is before the tax. So now meaning out of the capital that our debenture holders have invested in our business, meaning out of that 850,000 rands, 15% of that is money that we pay every end of the year because we agree to pay this to our debenture holders. So that becomes our interest, but before tax. So we have to say 850,000 and we multiply this by 15%. So meaning 127,500 will be the interest that we will be paying to our debenture holders every end of the year. But we must know that 28% of this will be allowed as a tax deduction. Let me confirm that tax rate is 28%. Let me check if we have any percentage. Yeah, there we do have. Our tax rate is 28%. Please do look at the rate, but currently the rate is 28%. So now we have taken that into account. Remember, this 127,500 is before tax has been taken into account. So now meaning we have to first say 850,000 rands times this by 15%, then times this by 72%. And when you multiply this by 72%, then it will give you the amount which is times this by 0.72. It will give us the amount after tax effect has been considered. 91,800 will be our payment of interest to our debentures or to our debenture holders. So now let us go to the next part, where now we are looking for the next part, which will be the interest according to the market. The interest according to the market. The interest according to the market. Now let me look for the interest according to the market. Interest according to the market, and they say the prime interest rate decrease since and the similar debentures are currently trading at 12.5% before tax. So we need to take into account the market rate when we're calculating the present value of this financial instrument. We need to know how much is the current value of the debentures according to the market. So now we have to say 12.5% times this by 72% because we need the interest after tax has been taken into consideration. Don't forget that. So now it will be 12.25 or 12.5. We multiply this by 0.75 after 28% has been removed. So now meaning our rate will be 9%, exactly 9%. This is our interest according to the market, which was 12.5%, 8% times this by 72%. Then after we can compute our present value. We want to know the value of this financial instrument according to the market values. So it will be 8 being our N, 9 is the interest, 833,000 is our future value, 91,800 is our PMT, and we compute our PV. PV is 926,151 rands. So it's 926,151 rands. I just want to confirm that my decimals have been all taken into consideration. Then we have, let me check if my figures are in millions. Oh, my figures are in millions. So we have 2,500,000 there. We have 1,250,000 there. Then we have, okay, I'll just keep it as is. But I'll also have now to adjust my ordinary amount, which I've already calculated that previously when I'm doing my weighted average cost of capital. Now let me proceed with that. I just want to confirm everything to be accurate. 850 million times 0.15, 1 million, okay, because I use the smaller figures. So meaning I have 850 million times this by 0.98. It gives me 8 million or 833 million. It gives me 833 million. Because I need to take into account all the zeros. So it's only 833 million. Because my ordinary were all the zeros, I took them into account. So I will only have to add zeros. For the PMT, it will be a total of 91,800,000 rands. So I only have to add the zeros. I just want to make sure that my answers are not different when I have to do my WACC. So let me just recalculate my PV. My N is still 8. My interest is still 9%. 833 million is plus minus my future value, 918 million or 91,800,000, which is plus minus my PMT. Then I compute my PV. So it gives me 51,000,007 or 006. So I just took all the decimals into account because my figures are given in millions. My figures are given in millions. And what I did once again, when it comes to the ordinary shares, I took the entire 20 million. So I have to be consistent and take the millions with all the figures so that I'm consistent with my calculations. So now this will be my PV. This will be my PV or my present value for the debentures, which is the third financial instrument. And the minute now I have completed this, I am almost at the completion stage. Let me check what else is given to me, or what else do I need to then calculate. Then we have trade and other payables, which are short-term funding. The trade creditors are paid within the credit period without any interest charge or discount received. The long-term financing structure does not include any credit or financing that relates to the working capital. And our bank overdraft rate is 20% per annum, and it forms part of the normal working capital funding. And under additional information, very crucial but doesn't affect my current calculations yet. 2015 expansion strategy. This is for the next year or the next accounting period. The strategy for 2015 is to expand the current service offering to the Eastern Cape area. This expansion will amount to, so we want to expand, and the expansion cost will be 540 million. The project will be financed in a ratio of 60 equity and 40 of our debt. However, 124 million of the retained earnings are available for funding the expansion. So now 124 million will have to be deducted as a retained earnings. And I want to go back now to our information provided in the statement of financial position. Our equity, take note, under our total equity. Under equity, we have shareholders' equity and retained earnings. So when they say 60% of the equity, they are referring to these two. So they say 60% will be funded through equity. However, there is retained earnings, which is 124 million that is available, meaning the 124 million of the retained earnings will reduce the 60% of the equity in terms of funding this project. So let me go back and clarify you again on that. So meaning the 60% of equity in this project, of which retained earnings out of that will be available, meaning we don't need funding for 124, meaning out of the 60% of equity, 124 million, we don't need funding because it is available within the retained earnings, and that is part of equity or retained earnings. Then 40% will be debt, and debt is in this case debentures. Then it says the new ordinary shares will be issued at the current market value, and the issue cost of 8% will apply. So now they are telling us that under equity we have to issue shares in that 60% after we have deducted 124 million, which is retained. Then we must issue shares. Then after issuing shares, then we'll have to calculate how many shares must be issued in order for us to raise funds through equity of that 60% after deducting 124 million. I'll show you that also when the question instructs me to do so. Current tax, and you may ignore dividends tax. Cost of capital is calculated based on the market values. Then after, we are required to calculate our weighted average cost of capital and make use of the financial calculator where applicable, and include steps on the financial calculator in your answer sheet. 22 marks is a giveaway question, or giveaway marks to grab in such type of questions. So now we are doing WACC, and I have done everything that is necessary for us to do WACC. Don't forget the cost of equity was calculated to be 20%. Let me remind you, maybe you forgot. We said that the cost of equity is equal to dividends at the end divided by the price plus the growth rate. And we said, how do we do this? We say dividends, which is 25 rand, dividends, ordinary dividends. I want to remind you of that before I start doing everything in my work. And we were told that dividends that were declared in the current period amounted to 25 rand. So that is our dividends. Then we know that these dividends, they grow at 7%. They grow at 7%. So we need to add 7%, which is 1 plus 0.7. 1 plus 0.07. We divide this by our price of the dividends according to the market. Don't forget, our price of the dividends according to the market, it is 200 rands, which is 225 minus 25, if you still remember that, because this 225 was after they added 25 rand of the cumulative dividends that were not yet paid. Let me just start writing it here in the beginning. 200 is the price, which is coming from 225 minus 25 rand plus the growth rate, and our growth rate is 0.07. Therefore, now that means the answer here, if you still remember, it gave us 20.375, if I still remember. 20.375, which came to 20% after rounding this figure off into the whole number. Now this will be 25 times 1.07 divide 25 times 1.07 divide this by 200, then plus 0.07, term that by 100 to get to our growth rate of 20.375. So this is the cost of equity. This is the formula that you must master in case it is there in your assessment or any assessment. So now we have reminded each other of everything that was outstanding, and from here now we can immediately do our weighted average cost of capital. Then we start with the capital structure, weighted average cost of capital. We start with the capital structure. Then after we have market values, and our market values are for each of the financial instrument. And there has to be a little bit of bigger space here because they are very long numbers in millions. Then after we have to go to the weight, which I call the weight of each financial instrument. Then after we have the cost of capital, the cost of capital for each financial instrument. Then after we have weighted average cost of capital, just a different color so that you know this is where weighted average cost of capital. That is the response to the question. Now we have different financial instruments. We have ordinary, which is after we had preference shares, then after we have debentures. Our market values, it was 4 billion, 1, 2, 3, 4, 5, 6. Let me just check that and use a bit smaller for visibility purposes. We had that 4, 5, 6, 7, 8, 9. Then for the next financial instrument, it was preference. Ordinary, there we do have our 4 with 9 zeros there. Then after we have now to come to our preference. Our preference, it was 1,500,000,000. Remember, I took into account all the zeros. Now, meaning in this case, we will be running away with 3 zeros. Remember that I adjusted some figures. So I should have adjusted everything. Then after adjusting everything, then the figures will come to the 3 zeros that I did not take into consideration. So we have that 1,500,000,000. Then we record that in our preference, 1 billion 500 million. Let me go back once again. Like, where is that 3 zeros coming from now? I want to take all the decimals because in my ordinary I took all the decimals. Now with regard to the preference, we had 15 million share that were each 5 million. Then that amounted to 1,250 million. Because our figures were in million, it is 1,250 million. So meaning we're supposed to have 3 zeros there at the end. So hence I take everything now into consideration. And if we do that, meaning it will be 1,250 million. And we multiply this by 12%, which means it could have been 1,500 million. Then after, meaning our capital now was supposed to be 1,500 million. Then after, when we divide that 1,500 million by 10%, it will give us the figure that we have. Apologies for such inconvenience. Then when we divide this by 10%, it would have given us the sum of 1,500 million. 1,500 million. So that is where now all these calculations are coming from. So we have this 1,500 million, which is our preference capital that must be allocated, 1,500 million. Then after we then go to the next, let me just clarify that very well. First, there has to be an adjustment, likely adjustment, 1,250 million times this 1,250 million times 0.12, meaning this would have been 1,500 million. 1,500 million. And it could have been 15. I'd confirm 1, 2, 3, 4, 5, 6. Then that would have been 1. Just want to confirm that figure. We have 1,250,000. Divide that by, or times that by 0.12. Then we have, I just want to confirm the zeros, 1,500, 1, 2, 3, 4, 5. Okay, it is 150 million. So our preference dividends were 150 million. They were 150 million. Then from that 150 million, then now we go and we calculate by dividing this by 10%, which was preference per annum. We divided that by 10%, which was 1 million or 150 million. We divided that 150 million by 10%, and it gave us the figure that we have. Sorry for that bit of inconvenience. It's very important when numbers are given in millions to take that into account at the beginning, because sometimes it does inconvenience some things. Then now we have that 1,500 million that we have. Then we have allocated that straight as it's supposed to be, and the last one is the 926 151,006. 926. We have 926 151,006. 151,006. 926,151,006. 926,151,006. So now we need to calculate the total so that we are able to determine the weight of each financial instrument. The weight of each financial instrument, it is 4 billion 2, 3, 4, 5, 6 plus 1 billion 500 million plus 926,151,006. Then I get 64 billion 261,000 or 261 million 5006 642 615 642 615. Make sure that's 642 615 1006. So there's a 1 there. 1006. 1006. Then now total is our total as it appears. Then now we have to say 4 billion for ordinary. Divide this by 642 6151 642 6151 006, and this gives us the weight as 62%. So the weight here becomes 62%. Then we have 1,500 million. Divide this by 642 151 00 01 642 6151 006, and this is 23%. Times this by 100 just to make sure that it is 23%. When you arrive here, you can just say 23 plus 62 equals minus 100. Then the last one will be 15%. Or you can say 926 151 006. Divide this by 642 1651 006, which is 14 times this by 100. Do you see we get 14.42? But we have to round it off, the last one, to be 15% so that our percentage is complete. So hence I first have to do the test. But we have to make sure that the last one is just rounded off to make your total percentage 100%. Because if we have 14% here, let me just show you that. If we have 14%, meaning our percentage will not be 100 because weight has to be 100. 62 plus 23 plus 14, we get 99%. So we need that 1% only to the last one. Please take note of that approach, very important to note. The cost of capital, we know that the cost of capital for our ordinary is 20%. We have calculated that the cost of equity or cost of capital, it was 20% for ordinary. Then we have to look for the cost of capital according to the market for other sources of financial instrument. For our preference, it was 10%. Remember, preference do not attract tax in terms of 28%, only attract tax which is at 20% for their dividends. But that is not applied in this case. We just keep that rate as is, as 10% in terms of preference. According to the market, don't forget, The one that we take is the one that is according to the market. And with regard to our preference, the market rate was 10% per annum. And our debentures, we had our market rate regarding our debentures, and the market rate was 12%. Then we multiply that by 72%, and it gave us 9%, if you remember. The same 9% that we used when we calculated the present value of the debenture. And that was the same 9%. It is the one that we are looking for. Please copy that and you paste as is. That is the market rate after tax, don't forget. These two don't attract tax, these two don't attract tax, but loan and debentures attract tax. So the interest or the cost of capital must always be after tax implication. Then we multiply, equals. Then after now we come back, we just multiply 0.62 times this by 20. It gives us 12.4%, which is the weighted average cost of capital. Just clear my 12% there. 12.4%. 0.2 times by 62. Yes, 12.4%. 0.10 times this by 23. It is 2.3%. Then we have 0.15, 15% times by 9. It doesn't matter which one you change into a decimal. 1.35%. Just change one of them to be a decimal. Then just to confirm, 9 times 0.15 plus 2.3 plus 12.4. This is 16.05%. So now this is the weighted average cost of capital, which is a 22 mark calculation. Which is a 22 mark calculation or marks calculation. I think it was 22 or 20 marks. Just to confirm, yes, 22 marks. So there was a lot to take into account here. Remember, we had to calculate the growth rate and calculate the cost of ordinary capital, or the cost of equity being ordinary capital. So hence all these marks are extending to 22 marks. So now this is complete. Then we can go to the next one, which is number B. Number B says to us that we must explain how the issue cost will impact the cost of equity of the new shares. For that, I normally don't go into theory, guys. Theory is, you can just go there, you read. But the cost of equity is determined by dividing the number, by dividing the dividends by the value of the shares. So now if the cost of equity is determined by dividing the dividends by the number of shares, it means the issuing cost will decrease the value of the same share, and therefore it will increase the cost of equity. That's exactly how it says in the theory, but I will not be writing that one down. Please go through the solution and just try to capture that. Then number C says we must calculate the number of ordinary shares which must be issued in order to finance the expansion. And now question number D is also theory, where we must look at two assumptions behind the use of the weighted average cost as the discount rate in an investment appraisal. So you'll also go to that. I will not be explaining such theory questions. My main target is just the calculations. Now remember, there was a project that needed to be funded by the value of 540 million rands. And now we are focusing on that project. The project needed to be funded to the value of 540 million. And we were told that 60% of that 540 million will be our equity. And equity, we have 124 million available in the retained earnings, because retained earnings are part of the equity according to the information that is provided to us. So now Here we do have our equity. Just to clear that first, here we have our total equity, and our total equity is made of shareholders' equity, meaning ordinary shares in this case because preference are there. Then we have retained earnings. So if now there is money available from retained earnings, which is 124 million, that therefore means that our 60% of equity must be reduced by 124 million because 124 million, which is retained earnings, is part of equity. Therefore, now the question is how many shares must then be issued? Remember, 40% of this 540 is our debt. So debt, we cannot issue shares through debt because debt is debt. It could be debentures or a long-term loan. So now let us then check how we attempt this question. Now we have to look at the number of shares, and the process of looking at the number of shares will be first to calculate the equity portion. We first have to calculate equity portion, the portion of equity. How much will be the equity portion? It will be 540 million times this by 60%. And when you multiply this by 60%, it will be 540 million times 0.6, meaning 3,240,000 or 32,400,000. Confirm that these zeros. 324 million, yes, 324 million. 324 million. These zeros are a bit disturbing, honestly. So this will be the part of equity regarding to this project. But we do have reserves available, meaning retained earnings that are available. So we minus that 124 million. Because they told us that 124 million is available as our retained earnings or reserves. So we have to deduct that 124 million so that we see how much must be raised through the issue of ordinary shares. So now we have 200 million. 1, 2, 3, 4, 5, 6. So we have 200 million of capital that must be raised through equity after 124 million has been reduced through equity called retained earnings or reserves. Therefore, now the question is how many shares must be issued? We do have the capital that we want to raise, and we know how much is the price per share. If you remember, according to the market, the price per share is 200 rands because we said 225 minus 25. This is the current price of the share before we added the 25 rand of the cumulative amount of the preference dividends that were not yet paid. So now our share price is 200. So now from this point, we can be able to divide this by 200, which is the price of our shares, in order for us to get to the number of shares that we are asked to determine. Divide this by 200, and it will give us 1 million shares. 1 million ordinary shares. So now it means the company must issue 1 million ordinary shares in order for them to fund the 200 million capital through equity. So this was the second requirement, which was number C on my main focus. And from here now, I can close because I will not be doing the theory part of the question. And I also hope that this question was very useful. Once again, don't forget to go to question 19. Question 19, Samson and Son, is a very important question that is very similar to the question that I have just done. Just to confirm the name once again as I am closing, it is question 19 in the 2017 question bank. Yes, Simon and Son. So with that being said, I think this is the end of the video. Hope this has assisted you. If you have any question, please do contact me via the online YouTube channel. Then I'll try to assist you where you need a question or where you need an answer in your question. Thank you. God bless you.